The agenda for today is I will give you a brief intro about myself, which is gonna take around 5 minutes. We're gonna talk a little bit about the context about why financial planning is important for startups, when they startups or entrepreneurs are typically asked for financial models, and why your financial model should be, work in progress. So like why and when you should come back to it. And then in the main part, we're going to build a very simple financial model. We're gonna talk about what is necessary to build that financial model. What do you need as a founder, as a startup owner, to build that? We're gonna build it within probably around 20-30 minutes. And we're gonna talk about how to do it a little bit in a simple way, and what are the sort of the tools that you can utilize maybe at the end from Uniflow that we provide. And at the end, if you will have any questions, which I hope there will be loads, we're gonna have the Q&A session. Let's start from my brief introduction. I was working as a financial advisor. I was lucky enough to get opportunity in the very early age to start becoming a financial advisor. And then I managed after 5 years, I managed to open my own retail store, as you can see over here, that is crossed because that retail store didn't work out. After 3 years, I had to close down the business because of really problems with the cash flow. And a lot of people says retail stores are the cash cows, which means you have a lot of cash. And it's true. But in those kind of scenarios, you need to know how to manage that cash. And even though I was a financial advisor, I didn't really know much about business finances. I was advising individuals with their personal finances, but didn't have much business financial knowledge. And that unfortunately led me to the closure of my first business, which also led me to the huge debt. And so that whole journey got me to the point where I was like, okay, I don't want to make the same mistakes. I love numbers. I will become an accountant. I will become bookkeeper, financial officer. So that's what I did. I've learned as much as I can about the finances so I don't make the same mistakes as I did previously. And after doing that for 4 years, I was like, okay, all of the Excel stuff are boring. All of that should be automated, should be much easier. Why not help people doing the finances? Because they should be fun, they should be easy, everyone should be able to understand and not make the same mistakes as I did. And so that's how the Uniflow really started 3 years ago. At the moment we've built the tools for people who doesn't have any financial skills, so they can see the future, they can predict the future, both for business owners but also for the individuals. There are separate tools. That was about me. I would say let's get to the main bits and bobs. Why financial models are really crucial for startups? Why do you need them? So first of all, in my own business, in my retail business that I lost, if I would have something like that and I would be able to see where I'm going within next year, 2, 3, maybe even next month, and I would be aware of that, I would make this decision completely differently. And what I did wrong, I did back then actually trust my accountant. And I was hoping that the accountant will tell me if something is going wrong or something is going, extremely well. But what was the case is that I got the information that is going wrong, but it was already too late. So that financial model back then, it would literally save probably a lot of stress for me, because I would knew with, few months ahead, where am I going? I would knew whether I will close the business much earlier, or what do I need to change to not get to the point where I have to close my business. So the financial model for your startup is like it's a guideline. At the end of the day, you are a CEO of your business, so you will make the end of the decision. not your accountant, not your bookkeeper, not even the CFO. They can advise you in some ways, but they won't make the decisions for you. And so, like I said, like I written over here, your knowledge will give you less stress because you will know where you're going. Okay, and understanding the numbers, it's much actually, those numbers in financial world are put really in a difficult way. So there is some, people doesn't think it's easy, but it is actually very easy and very straightforward. It's not as difficult as everyone says. But so then when do you need the financial model? In my opinion, you do need it probably at the stage of starting thinking about your business, starting thinking about building something. You have an idea. Okay, let's build a very simple financial model. Let's see whether that idea even makes sense. Let's see whether I need, maybe think about different pricing strategy, or maybe I don't want to build that product. I don't want to build this because I won't be able to, get to the number of people, of customers with this product, and I should shift to something else. And so doing that financial modeling at the very early stages, it's extremely important because, again, it gives you guidance. It gives you the future perspective of how that business could look like in a few years. And so when you have that business already, you will need the financial model for fundraising, because every single investor, every single serious investor will want to see the projections of your revenue. They will want to see what kind of expenses you are expecting and what kind of growth you are planning to have before anyone will, commit any funds to you. And so that's the first point. The second point is strategic planning. When you have already those funds and you need to scale your business, let's say, you need to take your business to the next level. And so then you can start thinking, okay, I need to hire those people to generate that kind of revenues, or I need to decrease the amount of employees that I have to cut my costs so my runway is a little bit longer. And so using financial model for strategic planning would probably save my business few years ago. And then if you go into the partnerships, some partners would require from you to see your long-term vision. Again, with loans or grants applications, whenever you want to take the money from the market, whether it's from investors or from banks, they will want to see the future of what's your plan? Where are you going? Why do you need that money? And obviously if you're selling your business, it's good to have the business model to just show off and sell your business for more money. So that's the scenarios when you will really need the financial model. And as you can see, it's all the time. Really, as a business owner, you should be on top of your numbers all the time. And so that's why the financial model is the continuous work in progress, as I mentioned, because you're going to change those numbers all the time. Every month, something will, change, especially with the SaaS businesses. When you have certain assumptions at the beginning of your journey, you think, okay, I will charge my customers that amount of money, and then I'm gonna have a second subscription that's gonna be that kinds of money. But that will change. And I can tell you on my own experience, in the last 6 months, I've changed my subscription model 3 times. I think 3 times. And in the past 2 years, I've changed my subscription model more than 10 times. It's just because you are forced to iterate your product all the time until you find the product market fit and you find that point where you are like, okay, people are buying that price point. And now I can, I can actually think how to change my sort of future in a different ways. Let's say cut costs, or maybe, iterate something else. And so that's why the financial models are the work in progress. You should work in them. Even if you're not a financial person, you should be able to work with them on a monthly basis to figure out what will make sense for your business. It will give you much better picture in terms of how to make the decisions about your growth. It will allow you to adjust all of your assumptions for the changing markets, and it will allow you to, see whether your decisions or the decisions that you are planning make sense. What else? Very often, if you get the investors funding, they will give you some feedback on your projections growth and your strategy. So then they will want to see the updated version of that. And so again, you need to do that. And you might think, okay, I can hire someone. Yes, you can. But at the end of the day, you need to know those numbers. And if you hire someone, like let's say an accountant, pay them £1,000, £1,500, they will create something for you. They will explain in the financial jargon, and at the end of the day, you won't be able to repeat it to the investor. And so having the knowledge how to build it by yourself and understanding what you're doing is not only good for your relations with the investors, but it's also extremely good for your understanding of your own business and where you are going. And so what is really necessary to build a financial model, and why people think it's so extremely difficult? And so from my perspective, when you're building financial model, you need to have the clear objectives. Okay, you need to know where you want to get with your business. You also need to know what kind of reason you have behind it. Like, do you build a financial model for fundraising or for strategic planning? Or maybe you're just building it for the valuation because you want to sell your business. Okay, to build a financial model, you need really 3 things. Well, that's a big picture, I would say. But yeah, it's a customer growth rate, how many customers you are able to reach. Okay, in the year 1, in the year 2, year 3, depending on how many sort of years you are doing that financial model for. Then you need to know how you will make money. So revenue streams. We can imagine that having the business at the end of the day without revenue, it's not a business, it's a hobby, right? So that's why every single business should have the revenue to, at the end of the year, make sure that we can generate some profit and get some money either for us or for our investors. A lot of early stage entrepreneurs forget that people who are investing in our startups are there to make money, to make profit out of our investments as well. So that's why your startup or my startup needs to start generating revenues, start to generate profits for us to be able to pay the money back to the investors so they can make money. No one will invest money just for, nice eyes. And then the third part is we need to, as a startup owners, we need to know what's our costs, because those costs will generate revenues. Whether it's a cost of marketing, whether it's a cost of salaries, or office, maybe that expense, that cost, office rent won't generate you revenue. But if you will have some, like a bank location, let's say, that will bring you more customers definitely, and that will bring you revenue. But yeah, basically you need to know your costs, whether it's operational expenses, whether it's a capital expenses. Those are 3 major pillars for building financial model. So you need to know how many customers you want to get, you need to know your revenue streams, and you need to know your costs. If we have those 3 things, we can very simply build a financial model. And so Shall we build a simple model in Excel? So I already have prepared we're gonna build very simple for 1 year financial model, so you can guys see that it doesn't have to be difficult if you have those 3 pillars that I was talking about a second ago. And so what I would like to start from is that first number. Let me just increase that. Is the number of signups. Okay, how many signups do you expect to have on a monthly basis or at the end of the year? And what's the growth rate of those signups? So let's assume that we're gonna grow 20% every single month. And I'm assuming, because building financial model, it's all about assumptions, especially pre-revenue. Okay, when you have the revenue, it's a little bit easier, but you're still assuming what's going to happen in the future, what you would like it to happen in the future. So let's assume that in January, we're gonna get to 1,000 signups. That would be beautiful. And then we're gonna multiply this number by 1,000 plus this times 20. And we need to block that. Okay, sorry for this. Okay, so at the end of the year, we're going to have 7,430 signups in the month of December only. So that's what is showing to us at the moment, right? And so already now you can start thinking, am I able to get to those monthly numbers of signups? Or is it too much and maybe I need to change that number to 10% because I don't feel like I am able to get to 7,000 signups every single month from December. And so, as I mentioned already, that number is already giving you an idea where you're going and whether you are able or you feel like you are able to sign up that many people. Okay? So starting with that, then we have, okay, we say, I am able to get those numbers. I am happy with those numbers. I will sign up 1,000 people in January. How many people will use my product? Okay. How many percentage of those people will use my product in the first year? Is it gonna be 10%? Because with signups, a lot of people are signing up, but then how many is actually using it? At the beginning, that percentage will be much larger of sort of dropouts rather than those who are using it. So let's say that in the first year, it's gonna be 10% again, for the simplicity of the numbers. And so once you have that signups already, you can very simply, you can very simply just add this over here. And so 100 people will use it in the January. And then what do we need to do over here is that we're gonna have another 1,100 people in February. So it's not only the number of those people, but it's also the numbers from the people from the last month, right? Because that's accumulates. And so this way, you'll see that you will, what happened? Oh, okay, I'm sorry, we need to block the 10% again. And then we need to block the 10% again. It's a work in progress. And then what you will see that out of 21,000 signups, you're going to have 2,138 people who are gonna use your product on a monthly basis. Okay? And so when we have that number, now we can go a little step further. What's your conversions? So how many people out of those who are using, because those who are not using, they're not gonna convert, or it's very, very low chance that they will convert. Conversions. How many of those who are using are actually going to purchase? And so good number is between 1 to 5%, depending on what stage of the business you are, depending on the pricing, obviously. But let's say it's going to be 5%. And so now from those 100 people in here, we're gonna have 5% converting. So 5 people will convert, correct? And then from those, we don't have to do that over here, but again, I didn't block it. Cool. Okay. So we don't need to add anything from here because we added all of the stuff that there's accumulated amount of users that are using on a monthly basis. And so the conversion rate will be 10 people. But what we should also do over here, we should actually make sure that we round that down. Round down. Okay, because obviously it's a number of people, so we cannot have 16.5, or we cannot have 38 and 2. So let's round them down. We actually should do that as well over here to make sure that it's a little bit more precise. Round down. I think I did do something wrong in here. Okay. So let's make sure that those numbers are a little bit more. And then our beautiful churn. How many people will buy but will cancel your subscription on the second day? In the second month, let's say. Churn. So let's say in the first month it's going to be 50%. In the first year it's going to be 50%. So we have, out of those 5, we're going to have 50% that are churning. And again, we need to round that down. Beautiful. So now we can calculate number of customers, correct? We know how many customers we're gonna convert. We know how many customers we're gonna lose, minus this. Beautiful. And so if we have those numbers, now we can think, okay, how much we're gonna charge them? So per customer revenue. Let's say we're gonna charge them $3.99, just for the sake of the exercise. We're gonna charge them this times $3.99 a month. And so if we're gonna get over here, again, I don't think I blocked that. We are looking at the sorry, I'm just gonna take this. And it did do, okay, nice. Okay, so we're looking at the £1,300 of profit, of revenue. So that's all without the costs, based on those numbers of customers, those numbers of conversions, the churn that we expect in the first year. And so what? Every single revenue have some kind of cost associated with it. So we should have what are the costs of that revenue. Usually for the SaaS businesses, what we have, it's a payment gate, like Stripe, for example. So let's add that over here. And so I'm gonna give the example of Stripe because I know it very well. So it's going to be 2% per transaction times from each transaction. So from each revenue that you're gonna give away 2% plus 0.2 from each transaction. So we have 5 transactions this month. So that's gonna be our cost. Okay, not a lot for SaaS businesses. That cost is not as big as in other types of businesses. Let me just do that this way, and then we can have our gross profit. Which is basically this minus our costs. Okay, and based on this, you can do your gross margin, which is one of the indicator that investors will look at, which is let me remind myself. I think it was minus. No, it was divided by this. Okay, the other way around, always making the same mistake. Param. Okay. Sorry. This divided by this. What is going on with this Excel? Sorry for that. Okay. So now we can do the percentage. Beautiful. Okay, so we have basic of our simple financial model. We have the first pillar. First two really pillars. We have our growth, our signups, and we have our revenues. And that's obviously for one revenue. If you would like to add more, we would add some over here, and we would add another revenue stream over here, and do exactly the same exercise and then summarize it. But let's not complicate it for now. Then we go into operational expenses, because every single business have operational expenses. Operational expenses. And so as I mentioned before, operational expenses may be something like marketing cost. It can be something like salaries. It can be something like, running servers, and so on and so on. All of the expenses that you have to run your business on a monthly basis, regardless of how much money you will make, they are your operational expenses. And so that's the part that none of the financial advisors will tell you what kind of marketing cost you're predicting. You need to know those numbers. No one will tell you how much you should pay your employees. You need to know those numbers. Some people can tell you how much the servers will cost, and you can find it. Your CTO or like person that you're working with can help you with that. But there is a lot of expenses that no one else will tell you, and you need to know. You need to make those assumptions for yourself, for your business, because it's your business. It's your decision how much you're going to pay your employees. It's your decision how much you want to spend on marketing and how quickly you want to grow. Okay, so again, just for simplicity, we're gonna say it's £1,000 over here, and let's say the salaries will be in the first year will be £40,000. The running the server will be £300 every month. Again, I'm just making that for really simplistic numbers, and then we should do the total of OPEX. OPEX stands for operational expenses. Okay, and simply like this, we're doing the summary. And I think what we also should do, we should do some nice formatting maybe, so we can actually have the proper numbers over here. We have already financial. Okay, so that's our total. Okay, of OPEX. Now we have CAPEX, capital expenses. So in terms of capital expenses, as a SaaS business, at the beginning, you probably won't have any capital expenses. A lot of people think that R&D will come as your capital expense, but at the early stages of your business, there is no R&D. All of your R&D is your operational expenses because you're creating the product, you're building that, so that's your R&D costs. When you establish your business and you have certain projects that you are sort of testing, then you can put that into the R&D perspective, into the capital expense. Sorry, as an R&D into capital expense. But what we would do if you have any capital expenses, like you buying if you're buying laptops, for example, because for your employees, we would add that over here, laptops, chairs, so like chairs, tables. But those are going to be larger expenses that are happening not on a monthly basis, they are happening one time. Okay, so let's say it's gonna be 2000. So those expenses usually doesn't happen on a monthly basis. You will have one bigger lump sum of money that is necessary for you to have the business. And so we're gonna do exactly the same over here. We're gonna add the total of capex. Okay, so we know. And so now what is good to do? What is to have some kind of contingency plan. And what contingency plan is to add around 30% for all of the expenditure that you are assuming that you will have. Unfortunately, no one, is a wizard from us and is able to predict perfectly fine how will you spend money. And a lot of times, even in your personal life, you can see that your expenditure is larger than you want it to be. You need to, pay for because your car broke down, or you need to go to the private doctor or something. And we are not able to predict everything. And so that's why it's good to have contingency plan. Contingency plan. Which will add you 30% to all of your expenses. So to do that, we need to summarize all of our expenses. Total expenditure. Okay, so we have this plus this, and then we can do the same with this times this, and the last value will be okay. So we have that, and now once we have all of this stuff over here, we can do the last part. We have our signups, which is our growth. We have our revenues, and we have our expenditures. 3 pillars that are necessary, correct? So the last part is to figure out, okay, let's see our cash flows. So how much money will I burn every single month? So cash flow, burn rate, and how much money do I really need to raise? So, and balance. So how to calculate the cash flow? Well, the cash flow is really how much money you're bringing to the business every single month minus your expenditure. So, sorry. I think that contingency plan we should add this value over here. Plus this one. Okay. Yeah. And that simple calculation of the cash flow over here is showing you that in the first month you will lose £66,000. And obviously that is based on salaries, on the marketing costs, on running servers, on the expenses for laptops, but it's already showing you how much it's gonna cost you to run your business in the first month and how much money on a monthly basis you actually will have to generate to start becoming profitable. Okay? So if we're gonna go over here, that's our monthly cash flow. Our end balance will show us how much money we will have month by month, accumulated sort of. So let's say that we have £10,000 on our account at the moment, or let's say we have 100,000, or we're gonna get 100,000 of funding. That funding plus this one will last us for the whole month. We're gonna last with 100,000 1 month only. And so because of that kind of calculation, because calculating the end balance, you can actually see how much money you need to have as a business in the first year. So at the moment, even if I'm gonna get 100,000, I'm still missing 560,000 in the first year of running my business. So now the question is, do I need to increase number of signups? Do I need to increase maybe how much do I charge? Because if I charge £10, that's gonna change. Do I need to, grow much faster? What do I need to do? Or do I need to cut the salaries maybe to £20,000? Maybe that will help. Now you are in the position to actually play with those numbers and see what do you need to do to get your business to profitability, because that's the end goal when you get the investors. The investors want to see profits, so those profits can do. And obviously, over here we do in just 1 year. What you would like to do, it's a 3, 4, 5 years, depending on what's your purpose of your financial model. If you would, most of the investors would like to see 5 years, which in my opinion, it's ridiculous, because after five years, those numbers sometimes are getting too ridiculous. For grants, sometimes you need 3, sometimes you need 4 years. For loans, it depends which bank you are going to. It's again between 3 to 5 years. So doing that for 3 to 5 years, it will show you a bigger picture of, first of all, how much money you need to raise to survive 12 or 18 months. How much money when will you get to starting seeing some kind of profitability, but also when you will have enough money on your bank account to cover all of the expenses, which is profitability. And so as you can imagine, we did it right now within around 30 minutes. And I did it because I've done that so many times, and I still made some mistakes with the Excel. So that's one of the big disadvantages of doing that in Excel. First of all, you need to know what you're doing. You need to know how to do it. Okay. Second of all, let's now imagine that I'm gonna start that from December, not from January. But in December, I'm not gonna achieve all of those numbers. So now I need to start moving all of those dates. If I want to make it January to December and then every single year, I need to start moving all of that. I need to start changing all of those assumptions. It's cumbersome. And then exporting it or sharing it with the investors, it's another big issue. So as you can imagine, it's not as easy to update it later on as it should be. And so that's where I was very frustrated building those financial models and updating them also for myself, spending hours on trying to figure out how to better present it to the investor. And I thought people should do it very easily. People without financial skills should be able to do it very easily. And so that's where our financial modeling tool came to place, where every single entrepreneur can actually use it totally for free. And if you would like to have any questions, I can take them now, I think. my favorite, and really on a monthly basis, there is one metric that would save my business in the past, is tracking your cash flow. And knowing where you're going. So when I was working, let me give me that example. When I was working as an accountant for charity, we were managing 10 different sites of buildings. The only thing we were doing on a weekly basis that was it was our cash flow. And so what does it mean? It means tracking all of the expenditures that you have and seeing whether it's going with the plan that you assign to yourself, and seeing how the unexpected expenditure is affecting your future cash flows. Because you may get some invoices, especially with the hardware. You may think that something will cost this way, but it will cost, some other amount of money. And so that will totally change. All of the other metrics are not as important on a monthly basis, but tracking your cash flow is, for me, is the most important metric for any kind of business, and every single entrepreneur should track. All of the other should be tracked maybe on the quarterly basis, biannually basis. I wouldn't go as specifically for monthly, especially as a entrepreneur, because that's more of a job for the investor, for maybe your CFO to track all of those metrics and advise you. But the cash flow, you need to be on top of your cash flow all the time. So at the end of the day, in my opinion, the financial planning is for you. So the base numbers should be as close to what you think as possible. When you're sharing the stuff with the investors, you are required to share them 3 different scenarios. So your base, your positive scenario, which is like with 20-30% better if you have more contracts, if you have more signups, if you sold way more than you were expecting, and with the worst scenario, which you sell way less and your costs are higher. Okay, so there are three scenarios that every investor would like to see. It's just for them to understand as well what if, because at the end of the day, as I mentioned a few times, they want to get the money back that they're investing. So they want to see what can happen if they will actually maybe, help you sell more. They will get their money back quicker because the investors are there as well to give you connections, to help you with different things. But what if certain marketing strategies doesn't work out? You should show them that scenario as well. Start testing your product as soon as possible. What you will think about your product is not what your customer will think about your product. And so that's the thing that I've learned in the past 2 years, that I would love to start testing my products or even my prototypes way earlier. I would save first so much time, so much money, and my products probably would look a little bit differently, because at the end of the day, I'm building them for people, not for myself.